Every money manager with a portfolio exceeding 100 million in assets is required to fill out a 13F filing that tells us exactly what stocks they are buying in their portfolio. This gives us great insight into what moves the super investors like Ray Dalio, Warren Buffett, and Michael Burry are making. And while we oftentimes hear about super investors making big bets on tech stocks like Tesla or Amazon, many super investors have recently been buying up dividend stocks. So in this video, we're going to be reviewing the top 5 dividend stocks that are most frequently bought by super investors. To analyze these stocks, we will be using my spreadsheets powered by Ticker Data, which you can download at the link in the description. And every Friday for the next 4 weeks, I'll be sending out a spreadsheet with the top 20 most frequently bought dividend stocks by super investors via my newsletter, and you can sign up for free at the link in the description. So let's go ahead and start digging in. So the most frequently bought dividend stock by super investors in Q4 of 2023 is actually one that was the largest holding in my personal portfolio besides the dividend growth ETF, and that is Microsoft Corporation. And you can actually see all this data when I plugged in the ticker actually automatically loaded in, and that is thanks to the help of the Ticker Data add-on in Google Sheets. But we can see this company is currently trading at $402.20 per share and has been on an absolute tear over the past year, up around 56.75%, and year to date up around 7.39%. Now let's go ahead and dig into the dividend metrics for this company. I'll come up here and plug in MSFT and hit enter. And you can see again, all this data is going to automatically load in thanks to Ticker Data. But the company has a starting dividend yield sitting right at 0.75%. So yes, this is a low yielding company, but the other dividend metrics look absolutely phenomenal. Let's take a moment and look at the yearly dividend payouts over the past decade. We can see they have gone from around 97 cents per share all the way up to $2.79 per share in 2023. And with the recent dividend hike, they are now paying out $3 per share in dividends. So that's phenomenal dividend growth over that time period. It gives them a 10-year dividend CAGR of 10.06 and a 5-year of 9.68%. So really nice dividend growth. But here's what's really beautiful about the company as well. You combine the great dividend growth with a low cash flow payout ratio. Free cash flow payout ratio at around 33.29 and a payout ratio of 27.36%. So we can see that dividend growth is backed by free cash flow growth. That's exactly what I want to see out of the holdings in my personal portfolio. So because of this, we can see the free cash flow payout ratio stayed in a pretty healthy range over the past decade with not a whole lot of movement for the most part. And now if we come down here, we can see my favorite chart on this entire spreadsheet, and that is the free cash flow gained versus the dividends paid out over the past decade. And the blue bar chart is our free cash flow and the red bar chart is our dividends paid out. So again, we can see steady increases in the dividends paid out, but the free cash flow grew at a very rapid rate. And again, this led to the free cash flow payout ratio staying in a healthy range and even declining a little bit over the past 5 years. So that leaves plenty of free cash flow left over for the business to do things like buy back shares or reinvest back into the business. Now let's go ahead and address if the company's trading at a good value. I'll come up here and plug in MSFT and hit enter. And again, all this data will automatically load in. Let's go ahead and jump over to our first valuation, and that is Graham's valuation. Now you could argue for a more mature company like Microsoft, this might not be the best valuation, but with the estimated earnings per share, our growth rate projection, and current yield on AAA corporate bonds, we come to an intrinsic value of around $246.61. If we jump over to our discounted cash flow analysis, we can see Microsoft has fairly high growth rate projections for their free cash flow at around 16%. So with a 9% discount rate, we can see we come to an intrinsic value of close to around $300 a share, which is a decent bit below the current trading price. Now the next valuation we'll look at is the multiples valuation. And while it is true there is no perfect comparable for Microsoft, you can see we're using some of the other big tech companies in the scenario, and they all have pretty high price to earnings multiple. The average price to earnings multiple for these companies is sitting at about 39.64. So when you multiply Microsoft's earnings per share of 9.72, you come to an intrinsic value of $385.33. Now the last valuation we'll look at is going to be our dividend discount model. And this one's pretty impressive for Microsoft. Now this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. So when we look at the historical data for Microsoft and look at those year-over-year dividend growth rates, we can see they had an average growth rate of about 9.5%. Moving forward, I'm projecting a dividend growth rate of 8.25% and a discount rate of 9%, and that gives us a dividend discount model price per share of $433, which is a decent bit above the current trading price. So if we jump over to the output tab, we can see the 4 valuations that we used in the scenario. Now again, I do think you can make the argument that Graham's isn't the best in this scenario. So if we remove that, we can see the average intrinsic value coming out to around $371.88. So it looks like it may be just a little overvalued at its current prices, but keep in mind this is undoubtedly a company that trades at a premium. But with a 10% margin of safety, you could see the acceptable buy price coming in at around $334.69. The second most bought Dividend stock is another one that I absolutely love and I own in my personal Dividend portfolio, and that is Visa, stock ticker V. If we jump over to Seeking Alpha, we can see this company's trading at $280.43 per share. It's been really good over the past year, up around 23.67%, and year to date up around 7.71%. Let's go ahead and jump over to my Dividend breakdown sheet. We'll plug in stock ticker V and hit enter, and all this data will load in. Now again, we are looking at a low yielding dividend stock, yielding around 0.74%. Now if we come down here and look at the yearly dividend chart, one of the things you may notice is it looks like they had a period with really nice dividend growth, but it looks like they may have cut their dividends. But is that actually the case? Well, one of the ways you can tell is if we come over here to free cash flow versus dividends paid, look at the red bar chart. That's their amount they've paid out in dividends every single year over the past decade, and you can see the amount they're paying out in dividends as a company has grown every single year. So why do the yearly dividend payouts look like this per share? Well, that's because in 2015, they actually had a stock split. So if we jump over to Seeking Alpha, we can see what this actually looks like. If we go ahead and zoom out and look at the past 10 years, you can see right here in 2015, they had a 4-for-1 stock split. So their dividend growth metrics actually look pretty phenomenal. We can see the 3 and 5 year at 16% and the 10-year dividend growth rate sitting at 18%. And their free cash flow payout ratio, just like Microsoft, has stayed in a very healthy range throughout this entire period of rapid dividend growth. And for the most part, it looks like it pretty much stays under 30%. And that's a big reason I absolutely love this company. But also look at the free cash flow growth rates, 10-year free cash flow CAGR of almost 23%. That's pretty unbelievable free cash flow growth, and a 5-year free cash flow growth rate of 14.36%. If this company can continue to grow their free cash flow at a rate like that, we'll see massive dividend growth again for the next decade. Now, if we jump over to our valuation, you can see we've already plugged in Visa. The first valuation, again, we'll look at is going to be Graham's valuation. Again, we can see once we plugged in our variables, we come to an intrinsic value of around $204.74 per share. With our multiples valuation, you can see the comparables we're using are MasterCard and American Express. Their average PE sitting at about 29.6. So when we multiply that by Visa's earnings per share, we come to an intrinsic value of right at $250 a share. Now, the last valuation we'll look at is going to be, again, one of my favorites for dividend stocks, and that's the dividend discount model. We're valuing it based on how much it currently pays out in dividends and how much that dividend is growing over time. Now, we're projecting a pretty decently high dividend growth rate moving forward of around 7.75%, and keep in mind that is backed by massive free cash flow growth, so that's definitely sustainable. But with a discount rate of 8.5%, we come to a dividend discount model price per share of pretty close to around $299. So when we jump over to the output tab, we can see the 3 valuations we used in the case of Visa. Keep in mind this is a financial company we're looking at, so the valuations we use for Visa are typically a little bit different. We're not going to use a discounted cash flow analysis in this scenario, but again, with those 3 valuations, we come to an intrinsic value of about $251.15. Now again, the current trading price sitting at $280.43, but this is definitely an example of another company that is quality and trades at a premium. But with a 10% margin of safety, you could see the acceptable buy price sitting at about $226.04. So valuation is obviously extremely important, but one thing you can feel confident about, 10 years from now, this company will be generating way more in free cash flow than it is now, and I think the share price will follow that free cash flow. The third most frequently bought dividend stock was none other than Apple, stock ticker AAPL. This is one of the largest companies in the world with a market cap of over $2.6 trillion. Now, this company has taken a little bit of a dive down over the past month, down around 10%, but over the past year, they've done pretty well, up around 10%. Let's go ahead and start breaking down those dividend metrics. We'll come up here and plug in the stock ticker and hit enter, and immediately we can get some pretty good insights. Now, the first thing we'll see, this is the lowest yielding stock we've looked at yet. 0.57%. So this is a pretty low yielding dividend stock, but the payout ratios are also the lowest we've seen so far. So payout ratio of around 15.5% and a free cash flow payout ratio of about 15.09%. So the company really doesn't use a lot of their free cash flow to pay out dividends. Now again, looking at this yearly dividend chart, it looks like they cut their dividend. But if we look at the amount they paid out in dividends, the red chart here year over year, again, you can see they've been paying out more and more every single year. So more than likely this is a stock split. If we jump over to Seeking Alpha, we can easily check this, and we can see right here, it looks like in 2020, they did indeed have a stock split. So that's why it's so important to look at this dividends paid out chart right here, because you can usually see that they're paying out more and more in dividends every single year, meaning there is likely a stock split whenever you see a chart like this. Now, if we come up here, we can see really nice free cash flow per share growth over the past 10 years, 8.37%. Now, the 5-year free cash flow is showing a little bit lower, but we can see it's actually because they had a little bit of a pullback in 2023 compared to where they were in 2022. But from a payout ratio perspective, this company pays out very little of their capital in the form of dividends. So if they really wanted to, they could actually hike this dividend quite a bit more. Now, if we go ahead and jump over to our valuations, I've already plugged in the stock ticker, but look at the beta here, 1.29. So you do typically see a little more volatility with this company. Graham's valuation, probably not the best valuation again in the case of Apple, but you can see after we plug in these variables, we would come to an intrinsic value of around $109 per share. A much better valuation for Apple would be a discounted cash flow analysis because it values the company based on how much free cash flow they produce in the future. And assuming a growth rate projection of about 10% for their free cash flow and a discount rate of 8.5%, we would come to a discounted cash flow price per share of $167.82, which is extremely close to the current trading price for this company. Now, the next valuation we'll look at is the multiples. And you can see the comparables we're looking at right here, Microsoft, Google, and Meta. They have an average price to earnings of around 32.24. So that's where the market is valuing these comparable companies. With Apple producing earnings per share of about 6.16, applying that same average price to earnings, we'd come to an intrinsic value of around $198.61. Now, the last valuation we typically look at is the dividend discount model. But again, this isn't the best valuation for Apple because they really don't use most of their cash flow to pay out dividends. So you could see even with a growth rate projection of around 6%, we'd come to a dividend discount model price per share of $40.70. So basically, I think it's safe to say that if you invest in this company, definitely don't do it for the dividend alone, although they do have the ability to pay out quite a bit more in dividends in the future. But here on the output tab, we can see the two valuations that we focused on the most, multiples and DCF, average them together and we come to an intrinsic value of $183.21. So with the current trading price at $169, it looks like the company may be a little bit undervalued at its current prices. And with a 10% margin of safety, the acceptable buy price is sitting at about $164. So it's not quite to that acceptable buy price, but it is getting pretty close. The fourth most frequently bought dividend stock was none other than General Motors stock ticker GM. Now here's what's really interesting about this company from a valuation perspective. If we look at the price to earnings ratio of these other three stocks we've looked at so far, they're all relatively high, but General Motors has a price to earnings ratio of just 4.86. The market is definitely not showing this company any love. Now let's figure out if that is justified. We can see over the past year, the company's down around 0.74%. Let's go ahead and zoom way out. Look at this the past 10 years. The company is only up 18.1%, so it has way underperformed the market during that time period. Now we're not even going to jump into the dividend breakdown for this company because I'll show you why. If we go over to the dividend history for this company, we can see they definitely had a dividend cut. Over the past 10 years, they increased dividends for a short time period and then they cut it completely in 2021 and 2022. And then we can see they brought it back, but quite a bit lower than it originally was. Now they did recently hike the dividend from around 9 cents per share quarterly up to around 12 cents. But there have clearly been some problems with the dividends for this company. Now with their current dividend payout, they're yielding around 0.96%. So this is another low yielder as of right now. Now let's go ahead and jump over to the valuations for this company. Come down here, we can see they have a beta of 1.5, so you will see a decent bit of volatility with this company. But here's what's interesting. Let's go ahead and look at Graham's valuation. Come over here. We can see earnings per share is projected to be about 8.87. So with a decent growth rate projection for GM at around 4, the current yield AAA corporate bond sitting at 5.01, it bumps the intrinsic value all the way up to $85.69 per share. That's way higher than the current trading price. Now in this situation, the next valuation we'll look at is going to be our multiples valuation. And you can see our two comparable companies here. They have an average price to earnings multiple of about 5.72. So again, that's pretty low, but it's still a little bit higher than GM. That would give them an intrinsic value of $42.09 per share. Now finally, if we jump over to our dividend discount model, we don't really know what management is going to do as far as dividend growth here in the near future, so this one's a little bit more difficult, but I do think they could achieve a 6% dividend growth rate for a decent time period. So with a discount rate of 8.5%, that would give them a DDM price per share of around $20.35. But purely from a valuation perspective, no doubt, the most interesting thing is that low price to earnings sitting at 4.58. I'll need to make a more detailed video on this company in the near future, but let's go ahead and jump over to our valuations. We can see all three averaged together, puts them at $49.38. So with a 10% margin of safety, acceptable buy price of around $44 and 20% margin of safety of $39.50. So it does on the surface level look like this company company may be undervalued, but I'll need to make a more in-depth analysis on this company in the future. And finally, the fifth most bought dividend stock by super investors was Bank of America, stock ticker BAC. And this is actually the highest yielding company we've looked at yet. You can see they're currently yielding around 2.71%, and over the past year, they're up around 3.9%, and year to date, up around 5.2%, trading at $35.42 per share. If we go ahead and jump over to our dividend breakdown, I've already plugged in Bank of America right here, and immediately, if we look at this yearly dividend growth, we can see phenomenal dividend growth for this company over the past decade. That's a 10-year dividend CAGR of 23.11%. That is massive dividend growth, and part of the reason they were able to do this is because when the financial crisis hit in 08 and 09, they completely cut their dividend, but since then they have been rapidly growing it back to where it was. Now the 5-year dividend growth rate a little bit lower at around 7.78%, so no doubt that dividend growth is slowing, but that's to be expected after the rapid dividend growth to build it back up. Now the payout ratio currently sitting at about 34.27%. Now we need to keep in mind this is a bank stock, so free cash flow payout ratio and free cash flow in general, not really something I typically like to pay attention to quite as much. For me, it's more about earnings with a bank. So we're just looking at the typical payout ratio sitting at 34.27%, which is a very healthy range. Let's go ahead and jump over to our valuations. We can see beta of 1.38, so you'll see a little more volatility than that of the market with this company. Now, if we jump into Graham's valuation, we'll go ahead and zoom in, and we can see this comes out to a pretty decent value, intrinsic value of $30.33 after applying your growth rate projection of just around 4. Now, the next valuation is one we haven't looked at for the entirety of this video because I really only like to use it for bank stocks, and that's the historical price to tangible book value valuation. Basically, what we do is we take the share price and divide by tangible book value per share, so we can see the historical price to tangible book value over the past decade. And I basically have it charted out right here. So we can see the average over the past decade was about 1.2, but the current is about 1.29. So compared to where it's been historically, maybe it's slightly undervalued, but honestly, it's pretty close to where it's been historically over the past decade. Now, the next valuation we'll look at is going to be our multiples valuation. We'll go ahead and zoom in, and you can see our comparables, JP Morgan and Wells Fargo. They both have a price to earnings of right at around 11.7 or 11.8. So average PE of 11.75, multiply that by Bank of America's earnings per share, and we come to an intrinsic value of $36.19. Now, the last valuation we'll look at, the dividend discount model. And again, we've seen pretty decent dividend growth like we just saw for this company, 5-year dividend CAGR of around 7.78. Moving forward, I'm projecting a dividend growth rate of 6%, discount rate of 9%, and that gives us a dividend discount model price per share of right at $34. So when we jump over to our output tab and average these three together here, we come to an intrinsic value of $33.48, which is pretty close to the current trading price. Now, we didn't apply the current price to tangible book value to our intrinsic value because it doesn't give us a straight up buy price, but basically we came to the same conclusion that it's trading pretty close to fair value, maybe slightly overvalued, because we can see there's around a 5.8% difference between the current price and the intrinsic value, but with a 10% margin of safety, you could see an acceptable buy price of around $30.13. Now, keep in mind, over the past year or so, there have definitely been opportunities to buy this company within that acceptable buy price. It even got as low as around $25 per share in October of 2023, and I actually added a few shares at around $26 and $27 per share to my personal portfolio. But there you go, those were the 5 most frequently bought dividend stocks by super investors in Q4 of 2023. Go ahead and let me know what you think of these buys and these companies in the comments down below. And if you want to get the entire list of all 20 dividend stocks bought by super investors for free, then you can sign up for my free newsletter at the link in the description. If you'd also like to get access to any of my spreadsheets and the ticker data add-on to automatically pull in stock financials, then you can sign up for ticker data as well at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.